Hey everyone, and welcome to The Explainer. Today, we're diving into Unit 1, Introduction to Accounting. Now, I know what some of you might be thinking, accounting? Really? But trust me, this is literally the engine that powers the global economy. We're going to demystify the core language of business. Whether you're an entrepreneur, an investor, or honestly just someone curious about how organizations actually function behind closed doors, understanding this stuff is completely non-negotiable. By the end of this explainer, you're going to know exactly how a company's health is systematically tracked and, more importantly, translated into a story that anyone can read.
But before we get into the nitty-gritty of modern ledgers, let's take a quick look back. Meet Luca Pacioli. He was this brilliant 15th century mathematician and friar who's basically known as the father of accounting. Now, obviously, he didn't invent the concept of counting money, but he did help formalize the double entry system that we still use and sometimes sweat over today. It's this really beautiful, crucial blend of art and science that gives us a clear picture of where a business stands. So here is our roadmap for Unit 1. We are going to cover the meaning of accounting, some basic terms, the essential concepts, the accounting cycle, and finally, the big one, the accounting equation.
All right, kicking things off with Section 1, the meaning of accounting, and answering the big questions. You know, when a business is operating with all its moving parts, it can look like total chaos. To make sense of that chaos, the American Institute of Certified Public Accountants defines accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events. Okay, so what does that actually mean for us? It means accounting isn't just tossing a bunch of crinkled receipts into a shoebox. It's a very deliberate, purposeful process that takes financial chaos and turns it into clear, actionable decisions. People mix these two up all the time, but there is a really clear divide between bookkeeping and accounting. Bookkeeping is your routine, everyday recording phase, the clerical work where transactions are logged as they happen. But accounting? Accounting kicks in right where bookkeeping stops. It's the analytical, summarizing phase. It requires a completely different set of skills to interpret those daily records and figure out the actual real-world financial position of the company. Which brings us to Section 2, Basic Accounting Terms. Think of this as the alphabet of business. Because before we can actually do accounting, we have to speak the language. We always start with the owner's relationship to the money. Capital is the net worth invested by the proprietor into the business. Plain and simple, it's what you put in. On the flip side, we have drawings. This is the exact opposite. It's any cash or even goods that the owner takes out of the business for their own personal use. Next up is a word you'll hear a lot, liabilities. Whenever you hear this word, I just want you to think of the word owed. A liability is simply the formal term for the debts and obligations your business owes to others. Think unpaid wages, loans, or money you owe your suppliers. Basically, the painful part of running a business. And we can actually split these liabilities into two distinct camps. You have internal liabilities, which are the amounts the business must pay back to the owners, like that capital we just talked about. And then you have external liabilities, which is the money the business owes to outside parties, like a bank loan or a vendor invoice. Now, on the complete flip side of what you owe is what you own, your assets. Assets are the valuable resources owned by your business, acquired at a measurable cost. These are the engines of your company. They're the resources you use to produce goods, provide services, and ultimately drive your revenue. A really common misconception here is that assets are always physical things. We actually split them into two categories. Tangible assets are the things you can physically touch. Cash in the register, the computers on the desks, a piece of land. But assets can also be entirely invisible. Intangible assets don't have a physical existence, but they hold massive value. We're talking intellectual property, patents, or even the goodwill a brand has built up over decades. Now that we have our alphabet down, let's jump to Section 3, the grammar rules of accounting. There are two fundamental rules here that you absolutely must grasp. First is the separate business entity concept. In accounting, we always treat the business as completely distinct from the owner. The books record transactions from the viewpoint of the business itself, not you personally. Second is the going concern concept. This rule dictates that we record financial data assuming the business is going to operate indefinitely into the future, rather than packing up and liquidating tomorrow. But perhaps the most crucial principle in modern accounting is the accrual concept. This is a real game changer. Imagine a business gets its monthly utility bill. Under the accrual concept, they record that bill immediately, not 3 weeks later when they actually write the check.
Why? Because the service has already been used. We record revenues when they are earned and expenses when they are incurred. We basically ignore the specific date the cash actually changes hands. Moving right along to Section 4, the accounting cycle. Let's see how this all fits together. So, how do we put these rules into daily practice? Well, the accounting cycle is this continuous circular flow. Think of it as tracking a single dollar on a journey from the very moment a transaction happens all the way to the final financial statements and then looping right back around again. It's a completely holistic process. It always starts at step 1, identifying the financial transaction. Then step 2, we log it chronologically in the general journal, our book of original entry. Step 3, we categorize it by posting it over to the general ledger. Step 4 is preparing a trial balance just to double check our math. And finally, step 5, we summarize the whole shebang into our financial statements to show the world how the business is doing. Which brings us to the climax of Unit 1, Section 5, the accounting equation. If you remember one thing from today, make it this single, elegant equation. Assets equals liability plus capital. It means that absolutely everything your business owns, its assets, must perfectly equal everything it owes to outsiders, which are your liabilities, plus the internal liability owed to the owners, which is your capital. If this equation is out of balance by even a single penny, your books are wrong. It is the ultimate truth of double entry accounting. Let's look at how this plays out in the real world with a guy named Kapil, who is starting a shoe business. On the financing side, he invests 80 lakhs of his own capital, and he takes out a 20 lakhs loan, which is a liability. So that's 100 lakhs in total funding. Now, how does he use that money? Well, he buys a shop for 40 lakhs, gets some furnishings for 10, buys a stock of shoes for 30, and puts the remaining 20 right into a bank deposit. When we add his assets up, they equal exactly 100 lakhs. His liabilities and capital perfectly balance out his assets. It's brilliant. Having mastered the alphabet, the grammar rules, and the undeniable math of the accounting equation, you are now holding the tools to accurately track financial health. Because accounting isn't just about doing math. It's the art of translating everyday actions into a crystal clear narrative of success or failure. The numbers literally never lie. Which leaves you with one final question to think about. Now that you actually know the language, what story are your business's numbers telling behind your back? Thank you so much for joining me for this explainer. Keep learning, and I will catch you in the next one.